In recent years, Chinese economic development has undergone a series of boom and recesses, making it critical for investors to differentiate between the two to realize significant profit margins and therefore positively impact the world. While China's economy has indisputably grown enormously over the past 30 years, it has been merged with waste, fraud, and theft of public resources by who is the government. This period of remarkable Chinese economic progress has been marked with increased employment rate, with hundreds of millions of the Chinese population being able to find reliable employment in the manufacturing sector in the major cities, therefore being able to flee adverse poverty. Additionally, infrastructural gains through the development and acquisition of high-speed trains, state-of-the-art transport hubs, advanced telecommunication systems, and a modernized military have enormously sparked economic growth. Even with such economic growth, China's economy has been faced with massive wastage coupled with high levels of corruption. Approximately 45% of Chinese GDP is gained from investments rather than consumption, as was the case in the US, a developed economy, where 70% of the GDP is from consumption and 20% from investments. Even though 45% of total GDP from an investment is right, considering that the economy is quickly growing with the intelligent allocation of investments in highly productive sectors, this is not the case with China. Half of the investment is wasted in the form of ghost cities, which are fully developed with modern skyscrapers, apartments, hotels, clubs, and transportation network, but lacking users. Chinese officials have openly and consistently denied the fact that ghost cities are a waste of investments, claiming that they are built for the future generations. These claims are off-beam, as such advanced buildings require occupants to achieve its functionality. After all, why were they built? Additionally, rents from occupants are expected to meet expenses and for frequent maintenance for them to remain functional and attractively modern. With time, these infrastructures will become obsolete long before they are occupied, leading to massive wastage of not only time, but also scarce resources, notably land. This is just one example of resourceful wastage by Chinese investors. Others include state-of-the-art white elephant public structures, such as train stations with marble frontages, almost empty escalators, 100-foot space with digital advertisings. Other almost empty or unexploited high-tech infrastructures include airports, canals, highways, and ports, accounting for immense wastage of resources. China is widely a communist society, therefore such wasteful projects are sanctioned by the Communist Party leaders, demanding that they are vital in the creation of employment for the vast unemployed, semi-skilled Chinese population. These projects, being ambitious, are highly labor-intensive and require abundant workforce in the areas of steel fabrication, glass installation, and general construction. In spite of these projects successfully solving China's unemployment problem, the solution is temporary, as the projects are short-lived, with the construction cost being covered loans which may never be repaid. China may report an annual GDP growth of 6.8%, but the actual growth rate reduces to approximately 4.5% when the resource wastages attributing to dead or unprofitable investments are factored out. China is also continuously accumulating unserviced loans, with the total debts growing overly fast than the economy. The debt-to-GDP ratio did not sound right and ranked worse as compared to the US. Chinese financial fragility, coupled with a failing economy, was clearly exposed during 2014-2016 partial collapse of its capital accounts. China could have avoided such an economic crisis if she had unlimited ability to roll over and expand its debt with the implementation of policies to deal with a banking or liquidity crisis. In early 2014, China had approximately $4 trillion in its capital accounts, but the amount fell to about $3 trillion by late 2016, attributed to capital flight for fear of Chinese devaluation, which occurred in August and December 2015. However, the remaining $3 trillion is not an assurance of a functional economy. This is because $1 trillion of the amount is invested in illiquid assets, which include hedge funds, private equity funds, and direct investments. Such investments are long-term and may not be available on a short-term notice to protect China's currency from imported inflation. The other $1 trillion in China's capital reserves are held as a precautionary fund to bail out the Chinese banking system. China's banking system may be insolvent due to the ability of the government to rescue them from financial turmoil, but this is not free. China has put aside $1 trillion to bail out banks in case they undergo a period of financial mayhem. The remaining approximately $1 trillion of liquid reserves serve to protect the economy from currency fluctuations to the yuan, which greatly harbors economic development. In 2016, China was losing $80 billion per month to defend the yuan at the height of capital outflows. If such loss could have prolonged for about a year, China probably would have lost $1 trillion in a year, leading to a weak economy. However, China acted swiftly and brightly to avert this situation by closing the capital accounts, leading to increased interest rates and further devaluation. China's frosty trading relationship with the US has further worsened the economic situation. It is eminent that such economic distress could be easily solved if the Chinese government had promoted and maintained a good trading relationship with the US. The trade war between China and the US has greatly damaged Chinese exports and significantly raised the cost of imports to China. Such an increase in export and import duty at a time when China was counting on a more substantial trade surplus to help it finance its accumulating debts undoubtedly paints a bleak future of China's economy. In coming years, trade activities in China will almost be dead, coupled with mounting debt that she may not be able to roll over, let alone repay. This will be the end of China's excellent economic success story and the start of a period of economic recession, coupled with a possibility of social unrest due to hard financial times. As much as there is looming Chinese economic failure, many observers openly dismiss such predictions as mere hypotheses, lacking sufficient accurate data to support the thesis. However, this may not be the case considering analyzed data from Stephen Guilfoyle, the Director of Floor Operations at the New York Stock Exchange. Stephen affirms that Chinese economic growth slowed to the slowest growth pace for the first time since 1992 and declined for the fifth consecutive month. Stephen's data, based on data released by the Chinese National Bureau of Statistics, paints a picture of looming economic failure. The situation may even be worse from the published data, as China has a long history of overstating its data to conceal the ailing economy. In reality, the Chinese economic situation may be worse from the released data. The economic slowdown followed the abolishment of presidential term limits, which gave Chinese dictator Xi Jinping the authority to serve for a lifetime to fulfill the Chinese communist ideology. According to the Book of Proverbs in the Holy Bible, pride comes before a fall, clearly foreseeing what is bound to happen to Xi Jinping's regime. Xi Jinping's political ascent filled him with pride, just as he presently faces the reality of a looming economic collapse and possible obliteration of any agreement around his power with the lack of accountability. As U.S. President Donald Trump continues to intensify the trade wars between the two nations by increasing the trade tariffs, China should brace for the worst. Investing in the U.S. markets will increasingly be hard due to harsh penalties and will undoubtedly lead to the withdrawal of Chinese corporates in the U.S. market.
We have all the cards. We're the bank that everybody's stealing from. I respect China and I respect President Xi, but they've been killing us. $507 billion in trade deficits last year. 507. Who the hell can lose 500? Then you want to do something about it and you get attacked. Oh, that's not nice. That's not free trade. The war was lost on trade many years ago. You know, when they were saying not a free trade, I said, no, the war was lost. But now we're going to win it. And because we have all the cards.
The looming Chinese economic collapse has threatened the global economy, causing panic through contagion in many nations, depending on China for the production of basic products. Additionally, other developing economies, notably Turkey, Argentina, and Venezuela, are on different stages of collapse and may indeed have a significant adverse impact on the global economy. The looming collapse of the Chinese economy can only be alienated by reasonable negotiation between Trump and Xi, leading to a rational compromise on trade and intellectual property. Xi should realize that his talk with Trump is not about ego or who should blink first. It's about saving the Chinese economy. Therefore, he should act swiftly and intelligently. Until now, Chinese people could only dream of a vibrant economy as the spirit of a looming economic collapse fills the air.